So Brendan, I heard there's like RRSP season right now. So what are some common mistakes that you see regarding RRSP?
So RSPs are fantastic for high income earning professionals or business owners because they can offset some of their taxable income in the year where their income's high. So big mistake I'm seeing is people who are contributing a lot to their RSP early on in their career when their income isn't actually that high. So that's probably number one. Number two is not holding their higher risk investments in their RRSP, thinking that they should maybe hold them in non-registered accounts. Now, I'm not saying if they're gambling to do that in the RSP, because obviously if they lose, they're not going to get the capital loss. Other thing is reaching out to their advisor on February 28th and asking to make the contribution. Huge rush for the advisor to have to do that at the last second, and it's better if you can chat with your advisor early on, do some tax calculations, chat with your accountant, and then make your RSP contribution, rather than doing it at the last minute.
So the max is like February 28th, that's like the limit?
Technically it's March 1st, but I always tell people it's the end of February, just to give them an extra day, because there's always going to be some last minute people.
For sure.
Yeah. But ultimately it's a smart tax planning move. And I think that more people who are earning six figures should look at RSPs. Yes, you lose a little bit of flexibility, and you'll have to get taxed when you take the money out down the road, but you get to pay less tax now, or potentially get a tax refund, which is pretty sweet.
Maybe tell me a bit more about for your second point on the higher risk investment and like the dividend investment. Why do you think it's better that those investment is in the RSP?
Yeah, so let's say people hold like a high interest savings account or like a GIC in their RSP. Maybe they're only getting 3 or 4%. They'd actually be better off to hold stocks, so companies that are paying dividends or potentially growth stocks, because they're not going to be paying tax on any of the dividends or the growth of those particular stocks. Just because then they're saving money on tax, a larger amount on tax. If your emergency savings, you can hold that personally in a non-registered account because maybe you're only getting 3% on that. But if you're getting 7, 8, 9%, better off to not pay tax on that on a regular basis. You know, like early days, if you're in 50 or 60 grand, just put that money in a tax-free savings account. You get the tax-free growth. You can save some of that RSP room for when you're earning six figures, and then start to stack that up because you're getting 30% or 35% marginal tax rate savings versus like 24 or 25%.